Hello, everyone. Welcome to Genwest Capital webinar series. I am your host, Irene Cho. Today's topic covered understanding the 5 C's of credit, a deep dive of the credit process from the lender's perspective. Just a little housekeeping before we get started. Please mute yourself during the webinar. We will have the last 5 to 10 minutes for Q&A session. So please ask the question during the Q&A session using raising hand emoji or writing question in the chat box. Before we get started, I'd like to introduce PACE briefly. PACE was founded in 1975. We've been helping low and moderate income people in the community for many decades. PACE is also one of the SBA Community Advantage lenders and CDFI. We are known for funding businesses that have been turned down by traditional financial institutions. We have over 25 years of experience in providing SBA business loans, direct financial assistance, consultant services, and entrepreneur training to individuals and businesses. Our knowledgeable business counselors and workshop make it easy to find solution for your business. If you have any inquiries, check our website or give us a call. Let's welcome our guest speaker, Edgar Darrow.
Thank you, Irene. Can you all see the screen?
Yeah.
Okay, great. So let me start with a quick story. A few years ago, I met a local business owner. Let's call her Maria. Maria owned a small and thriving catering business. Her food was, great. Her customer base was growing, and she just landed a big contract with a big corporate client. But when she applied for a $50,000 loan to buy a commercial kitchen equipment, she got denied. She was surprised. She had income, she had clients, and the momentum of her business are going great. So, what went wrong? Well, she didn't understand the 5 C's of credit. Her personal credit had a few late payments. Her business had almost no capital reserves. She didn't list any collateral, and her industry, which is restaurant, was seen as a high risk at that time. Even now, it's still considered a high risk. But it wasn't about, her potential. It was about how lenders assess risk. If she had understood the 5 C's of credit, she could have prepared a stronger application and make a better case. So that's what today's session is all about, helping you avoid that mistake, helping you understand how lenders think so you can walk into that bank of yours with confidence, walk out with an approval. So let's get into it. I am Edgar Darrow. I'm commercial loan advisor with Genwest Capital, and I want to thank you for joining us today. Whether you're launching your first business or scaling an existing one thing is certain. Understanding how lenders evaluate you as a business owner is key to obtaining the capital that you need. Whether the loan is $10,000 or $10 million, it all begins with the 5 C's of credit. This is the standard evaluation for every loan application. What are the 5 C's of credit? At the core of every loan decisions are 5 criteria. These are character, capacity, capital, collateral, and conditions. Think of this as your credit report card, and each of these C's is a section with its own score. So let's break each one down. Character. Character is all about trust. Lender wants to know, can I trust you to repay my loan? They look at your personal and business credit scores. Yes, both. Your personal credit can influence everything from loan size to interest rate. Most lenders pull from Experian or Equifax. So things like payment history, collections, bankruptcies, they really matter. And when I say lenders, I'm just talking about business loans. When it comes to residential, I'm sure most of you know, they will pull all 3 bureaus, Equifax, Experian, and TransUnion. However, with business lending, most of them just pull either Experian or Equifax. All right. So just a thought, just a quick poll here. How many of you have checked your credit report within the last 6 months? You know, have you considered that if you're thinking about getting some financing? In case you haven't, I would suggest you do. And just, you know, that's just your starting point. Now, like I said, the lender sets their own minimum credit scores. The higher the score, the lower the risk you get, meaning you will get a low interest rate and a favorable terms. Now, when it comes to your personal credit, it is very important to check up on it on a regular basis. As an example to this, if in case you haven't gone and checked your credit, there's a free app, I would say, and the website that you can check your credit report at no cost to you. It's called annualcreditreport.com. It allows you to check your credit on an annual basis for free of charge. So gratis, basically. So these are available either with Equifax, Experian, or TransUnion. Now, you're probably asking, what about business credit report? Your business credit report includes financial data, trade lines, collections, and even UCC filing. Your business is an essential part in evaluating this credit worthiness. So the lender basically obtain 2 main sources for your business credit report. One is Experian and one is Dun & Bradstreet, or DNB, in other words. What is on your business credit report, if you were to ask me? They contain your business background, company information, credit scores, risk factor, banking and trade collection history, liens, judgment, bankruptcies, UCC filings. With the business credit report, your score is a little bit different than your normal credit score. In your screen right now, you would see an example of a business credit score provided by Experian. So high risk would be considered a 1 to 10. A score of 60 is preferable because it represents a low to medium risk as far as lending is concerned. So if you get a score between 51 to 75, you're in good shape. Anything below that, you know, you may still be able to get a loan. However, you know, there are other compensating factors that they would consider. But safe to say, if the score is between 51 to 75, Very good chance, very good chance. Another scoring guideline that lenders use is called Paydex score. This is from DNB, Dun and Bradstreet report. So theirs is a little bit different. However, it accomplishes the same thing. It rates, the risk of each businesses as to your particular profile. So a score with a Paydex score, a score of 80 is considered low risk. So anything below that, medium, moderate risk. And then, below 50 is about high risk. So chances are, you may not be able to score high in this category. So they will compensate that with the other 5 Cs of credit. And basically that's how, you will see in this presentation that it all makes sense where it's different buckets. It's, your credit report card. So they average that to get your loan approved. Now, as far as UCC filing, in case most lenders file this if the loan amount is a little bit over 150,000. So UCC filings is a form of filing, securing your assets as collateral, basically. So it enables the lender to seize your asset in case of loan defaults. That's all it is. So it's recorded at a state level, and they will record what they call a UCC1 filing. And then when you pay off the loan, they will release it. So they'll file a UCC2. The next category is for the 5C is your capacity. So capacity asks, can you afford the loan? This is where your cash flow comes into play. Lenders calculate something called the debt service coverage ratio, DSCR. And just remember this, your magic number, the magic number here is 1.25 or higher. The higher your DSCR or DSC, the better for you. So if you get, when you calculate your cash flow, if that sum is 1.5, it means it's way better than getting a 1.25. So the baseline minimum debt service is 1.25. So in other words, if I have 100,000, I must make $125,000 to service a loan, basically. And the lenders, when I say the lenders look at two different calculations. One is just the personal cash flow analysis, and then they will combine this with your business. And combining this is called your global cash flow income. And when they look at your financials, and when you submit your financials, the reason, I don't know if you've noticed, when they ask for documentation, they will always ask for 2 years tax returns or 3 years tax returns or 3 years financial statements. The reason being is that when it comes to calculating your ability to afford the loan, they don't rely on the future. Lenders will always rely on your historical cash flow. So historical cash flow rules. So most of the time, if you have a 2-year history that's been growing and it's been profitable, chances are you probably will get an approval. However, if you have, let's say, 1 year for 22 and 21, during the COVID years, you haven't really recovered, and you have 24, which is way better, chances are they will still consider that, but they will look at your historical, they would look at your credit, to see. So having the capacity along with the credit also helps. So as you can see, we can tie that in now. So your capacity and then your personal credit score. Now, how do you calculate the simple cash flow analysis? It's basically your net profit. So this is everything subtracted after your expenses and operating expenses and all of that. So you add all non-cash items such as depreciation, interest expense, anything that you can add back. Like for instance, if you're buying a real estate property, you can also add your rent. So you can end up with your total business cash flow. So that business cash flow right there, divided by the proposed loan amount, monthly loan amount, should equal a debt service coverage ratio of whatever it is. So like I said from earlier, a debt service ratio of 1.25 or higher is better. Now, take that business cash flow plus your net income equals your global cash flow. This is the second test to measure your capacity. So they combine your personal liabilities and your business cash flow and all of your debts, and they subtract that, and they combine your debts divided by your proposed loan. Again, if the answer is 1.25 or higher, then there's a good shot. There's a good chance. Now, having said that, if you're applying for other types of financing, which I've discussed last week, there's a different formula that these lenders, these alternative lenders, show and calculate their analysis. So if you're talking about an MCA or short-term loans, they base their approval on bank deposits and the number of NSFs on your bank statement. So what they do is they will average the annual deposit times 10 to 20%. So that will be your eligible loan amount. So for instance, if your annual average deposit is about $100,000 times 10 to 20%, your eligible loan amount would be $10,000 to $20,000. And then, of course, the payments will be taken out from your account on a weekly or daily basis. Now, with asset-based lending, which, if you have receivables, this is the analysis is based on your aging report, your accounts receivables or accounts payables. ABL or asset-based loans, they look at account concentration. So if you have, as discussed last week, if you have accounts that are more than 25% with one client, they don't view that as a good risk. They want something spread out. So less than 25% account concentration is better than having a 25% account concentration with clients. What they do is they subtract the total accounts receivable minus accounts over 90 days. They multiply that by 80 to 90%. And whatever the sum is the eligible credit amount. Now, third one in this 5 C's is capital. It means how much skin do you have in this game? Lenders wants to see you've invested your own funds, especially if you're just starting out. They'll check your business liquidity and net worth. Capital means your business checking account, your savings account, your liquidity, especially, like I said earlier, on startup businesses, they would want your money as well. So your equity injection. So you probably hear of that term, equity injection. It just means how much skin are you putting in the game, basically. So on a project, let's say you're starting a restaurant, and your total project cost is $300,000. The minimum amount a lender would usually require is about 10% of that. So your capital injection is 30,000 based on a $300,000 project amount. Now, the fourth one of this is your collateral. It's just in case as a safety net, basically. So collateral can include like things like real estate, machineries, inventory, accounts receivable. Lenders prefer a 1-to-1 ratio. So a question that I always get asked is, do I need to have a home to get an SBA loan or a business loan? The short answer is no. However, there's a ruling within SBA that if you own your own home and you have some equity in it, then they are expecting you to provide that as a collateral. So, like I said, it's just a safety net for the lender to give you the money that you need. If you don't own a home, no harm, no foul. They will still consider your business loan application. They may take out your business assets, like we talked about earlier with the UCC filing. So they will put a filing on all of your business assets, equipments, furnitures, and machineries to secure the loan. So if you have a 1-to-1 ratio, better. If the loan ratio is less than 1-to-1, they can also approve the loan as long as the previous three that we explain, your character, your capacity, your capital is there. Collateral just kind of sweeten the pot, basically. So as long as you have those four, then you're good. You're good to go. Preferably, collaterals can be released if you have a home. If you're refinancing it, they can secure a temporary release of that collateral, and then they can put it back. So a lot of cases where there's a homeowner that went and got an SBA loan, they are now wanting to refinance. And the problem is SBA has a second trust deed on the property. So what happens is that SBA will temporarily release their collateral portion so that the first mortgage can record the mortgage amount. And then SBA will come back and re-record their second position. And last but not the least of the condition, or rather the 5C, is the condition. So the fifth, the condition includes everything from your industry trends, economic conditions, or even your business current financial health. So the industry plays a big part. So like let's give a specific example today. Most of businesses that deals with foreign trade, as you know, as you may well have heard in the news, there's been tariff negotiations and some concerns about it, especially with China and some other countries. So if you're that type of business and I'm the lender, I would consider, lending you based on what the current market situation is. So there's some volatility right now with foreign trade. So lenders are kind of leery or weary about making a loan to certain companies that deal with like I said, China or some other Asian countries because of this ongoing issue. However, it doesn't mean that you won't get approved. Having the right condition would also add into the bucket that requires for you to get the approval. So if you have the 5Cs in hand, and let's say you have 4 out of 5, uh, all good with the rest, and it's just a condition, it's more than likely that you can get approved. I think to wrap it up, if you understand how lenders think, you can better prepare, improve your chances of approval. If you have any questions or want to discuss a specific situation, feel free to reach out.
I think we have a question,
Okay.
a Brent. I'm gonna unmute. You can talk.
Okay.
Okay. Can you can unmute?
Hi, no, I'm sorry. I accidentally hit that. That was a great presentation. Thank you.
Oh, thanks. Go ahead with your question.
No, she was
Oh,
accidentally pushed.
all
Yeah.
right.
Okay. Any questions? Okay, I think we're all good.
Okay.
Okay.
Thanks, everyone.
Thank you for joining us. We will have the last session next week. Hope we can see you there. Thank you, Edgar, and thank you, everyone.
Thank you.
Bye.
Bye.